This is Brent from TradeGuild.net. It is the 25th of August at my typical time, 1 a.m. in the morning. It's been a little while since I've done a video. Had a little bit of business to take care of, but I'm back. So let's take a look at the market and see what's been going on. First of all, on Friday we had some pretty decent buying. Not a lot of conviction behind it though. There's not a lot of volume. So we had some decent price moves, but the buyers were just not showing up in force. Getting the move kicked off pretty early, Reuters reported that Korea Development Bank may be interested in buying Lehman Brothers. That set the early tone. That kind of got squashed pretty quickly, though, as Moody's downgraded Fannie Mac and Freddie Mae. That was the preferred shares they downgraded. Now, the problem with that is that these equities are held by financial institutions, i.e., read that as banks. Major banks, brokerages, and such. Now, if a government bailout comes, if Freddie and Fannie have to be bailed out by the government, the fear is that we're going to see another round of major financial institution write-downs. So that could be trouble, and that got things kind of on a sour note a little bit later in the day on Friday. We had Warren Buffett. He was out there talking about Fannie and Freddie, saying that they're out there looking for private investment. He's also saying that he's got no bets against the U.S. dollar, so that's an interesting development. Uncle Ben from the Fed, he's also out there talking the dollar up and saying that it's likely to slow inflation. I'm sure that's what he's praying for. Is the U.S. weak dollar policy finally over? Maybe we can go to Rome and afford a cup of cappuccino finally. So oil rolled over on Friday. That was based on strength in the dollar. Keep in mind how the dollar and oil are connected. Throughout the world, oil trades in U.S. dollars. As U.S. dollars gain in strength, oil is marked down. Now, over the last 8 years, we've seen just an unbelievable decline in the value of the U.S. dollar. So what happens is, you have these countries that are selling their oil, and the U.S. dollar is worth less and less, so they have to mark up the price of oil. That's not been the only thing going on. There's, of course, been, financial speculators, but a large degree of that has been due to the dollar. So on Friday, oil did roll over because of the strength in the U.S. dollar. We're going to take a look at the dollar. And we're going to get to that in just a minute. First of all, I got the spiders up on the screen. That's the ETF for the S&P 500. Through July here, we've been watching this little formation over here. It looks like an ascending wedge, you can see. And this is kind of a bearish formation, even though we're seeing price appreciation over here. And the reason why, I'll tell you. Well, first let me tell you this. My letter that I send out, my contributors letter, on the morning of, what was it, the 18th, or I'm sorry, the morning of the 19th, before the market opened, I said, watch out. I think that this market is going to break down below this this wedge, and that was exactly what happened. This is the morning of the 19th, and later in the day I said, watch out. Something doesn't look right here. This could be a head fake. And a couple days later we saw a move up. I'll tell you what I think is happening here in just 1 second. But first, let's take a look at the actual gain. We had a 1.45% gain, which is a decent gain for the spiders. Okay, this is how you would trade the S&P 500. If you didn't want to buy all 500 stocks, you'd buy the spiders, the SPY, which is the basket of all 500. If you notice, the volume was decreasing. On a strong move, we should see the volume expand as price appreciates. But that was not so. That was not the case. Now, if we zoom out a little bit and take a look at a 5-day chart, so each bar is going to represent 5 days, what we have is a formation here that's called a bear flag. If I can find my marker here, let me see if I can draw on the screen. A bear flag looks pretty much like an inverted or upside down flagpole. So here would be the flagpole. I'm not a great artist here. And then here would be our flag. A bear flag is a consolidation pattern. And consolidation patterns, typically resolve in the direction of the primary trend. The primary trend here is down, so the consolidation pattern, once it broke, would be down. And we can measure these moves. We can get an idea of how far they will go once they break, and how we do that is we measure the flagpole, so from the top of that to the bottom of that, and once we get our break, we take that distance and we just subtract it and we go down. We'll take a look at the Dow, and I'll show you how to do that in a minute on the Dow. But one other thing I wanted to show you, with bear flags and consolidation patterns in general, one thing you want to look for is volume, and volume is a big part of these formations, and it's how you can validate them and say, are they for real, or are they just an anomaly? And what we look for is declining volume as the formation advances. So here's the formation advancing, and here's our declining volume. So this tends to validate the idea that this is a bear flag. And keep in mind, we're in a bear market, and this is a rally, and this is a bear market rally. What is a bear market rally? Real simple. Let me clear the screen up real quick. We'll go back to a one-day chart. A bear market rally. We're in a bear market, meaning our primary trend is down. A bear market rally is where we get a counter trend move up. It's not strong enough to create a new primary trend, but what happens is we have institutions, that are still holding positions, and they're at a loss, and they need to unload those positions. Well, what do you need to unload a position when you're in a bear market? You need demand. The only way prices move up is through demand, and the only way to create demand is basically to create a believable rally. So bear market rallies tend to be very believable, and that's why people get sucked in, money gets sucked into them, and people think that this is the new bull market. And what happens inevitably is the suckers get sucked in, the institutions unload their shares at more favorable prices up here. Basically the retail crowd, i.e. you and I, get stuck holding the bag as prices tend to fall again. When we look at formations like this is a pretty scary formation, because typically a lot of times they will break down just like this one broke down. What will happen is they'll break down, and then they'll come back and what I call kiss the channel or kiss the formation goodbye. They'll come back and give it a smooch, and then they'll fall right back down. I do think there's a possibility here that there's a little bit more upside. If we take a look at an intraday chart, a 5-minute chart, and actually let me back this out a little bit so we get a better view. This is one day, the span from here to here, and what I'm going to do is show you another consolidation formation. And let me grab a couple trend lines here. There's a straight line across. This represents resistance or supply, and this is where we have supply, so prices are basically turned back. The sellers are up here, and there's not enough buying to move prices through that level. But we also have the buyers getting more aggressive, and every time prices come back down, the buyers are getting more aggressive, more aggressive. So this is an ascending triangle, that's what we call it. It's a bullish formation, meaning they typically resolve to the upside, and what you generally would do is you would take a measurement of this, and let's say it's about 128.50 to 129.50, and that measurement, you can just pretty much measure the backside, 129.50 to 128.50, that's $1. Your breakout would occur typically on good volume, and we see some pretty good volume over here towards the end of the day, but we don't see the breakout yet. And that breakout would occur, and then you would typically see a move equal to this. So, at 129.50, we'd expect to see a move to about 130.50. If we jump back to that daily chart and we take a look at where 130.50 would end up, and I'll zoom in a little bit. Let me pull out a pointer. 130.50 would put us right about there, which is resistance, meaning that prices have not been able to, the buyers have not been able to push prices through this level. There's a level of supply, there's a level, basically they're sellers at that level. So unless we see volume really pick up, I doubt that we'll see the spiders move through that level. So all in all, I wouldn't be a buyer at this point unless we really see a move through that level, through that 130.50, ultimately through 132. Then maybe there's a chance here. Let's take a look at the Dow Jones 30.